What if your stocks could pay you extra income every single month without you actually having to sell them? Welcome to this Box of Wall Street Explainer. Today, we're unlocking the secrets of the covered call strategy.
Thousands of long-term U.S. investors are using this exact, highly repeatable method right now to generate consistent cash flow from their existing portfolios. So if you hold solid stocks and you really want them to work a lot harder for you, well, you are in exactly the right place.
Section 1. Intro to Covered Calls. Your very first step to generating income.
All right, so what exactly is a covered call? It's an options income strategy built specifically to optimize those mature, stable holdings you already have. Think of your favorite large-cap dividend stocks, or maybe those super reliable ETFs just sitting there in your brokerage account. Here's how it works. You already own the shares, right? So you sell a call option against those shares. When you do that, you collect an immediate cash premium. The person buying that option is literally paying you for the right to buy your shares at a set price later on. That premium, it's yours to keep right now. The trade-off is just that you're limiting your upside potential beyond a specific strike price that you get to choose. Now, the absolutely crucial point here is the rule of 100. You absolutely must own at least 100 shares of a single stock to sell a single call option contract against it. That number, 100, it's your golden ticket. Why? Because one standard options contract represents exactly 100 shares. Without those 100 shares, you simply can't safely execute this specific strategy.
Moving on to Section 2. How the strategy works. We'll look at the step-by-step mechanics and some real examples.
Executing this in your own portfolio is actually a very straightforward four-step linear process. Step 1. You purchase or already own those 100 shares of your chosen company. Step 2. You select an expiration date and a strike price that you are perfectly comfortable with. Step 3. You go into your brokerage platform and sell one call contract against your 100 shares. And Step 4, which is definitely everyone's favorite step, you collect that option premium immediately. The second you sell that option, cash goes straight into your account. Once that premium is collected, you basically just sit back and wait until expiration to see how the stock performs.
So let's look at what that actually looks like on a timeline. On day 1, you sell the option and collect your cash premium. Cool. Around day 15, you're simply monitoring the position. You really don't have to do anything at all. Then, by day 30, or whatever specific expiration date you chose, you reach the resolution. If the stock stays below your chosen strike price at expiration, the option just expires completely worthless. And that is great news for you, because it means you keep your 100 shares and you keep that premium free and clear.
Let's apply this to a real-world scenario with a classic blue-chip stock. Imagine you own 100 shares of a solid company, currently trading at $100 per share. You set your strike price, which is your target selling price, at $105, and you collect a $2 premium per share for selling the call. Now check out that max profit row. Your maximum profit is strictly capped at that 105 strike plus your $2 premium, meaning the absolute most you can walk away with is $107 per share, even if the stock suddenly rockets to 120. But on the flip side, look at the break-even price. It drops down to $98. That's because that $2 premium gave you a nice built-in buffer against price drops.
Looking at the core objectives derived directly from our source material here, the primary goal is crystal clear. Generate income from your existing holdings. It confirms you absolutely need those 100 shares per contract, and it explicitly relies on the option premium for that income stream. Crucially, the ideal market environment for this is sideways to moderately bullish. Think about it. If a stock is just trading flat, a traditional buy and hold investor makes absolutely nothing. A covered call investor, however, they are out there manufacturing their own yield.
Section 3. Benefits and ideal markets. Why long-term investors love covered calls.
The benefits here are incredibly compelling. First off, it generates recurring income. You can do this month after month on the exact same 100 shares, assuming they aren't called away. Second, because you are consistently collecting that premium, it actually reduces your overall portfolio volatility slightly. It acts kind of like a shock absorber against those inevitable market bumps. This is exactly why it's so incredibly effective in sideways or moderately bullish markets. Plus, if you're already holding dividend stocks, this premium income is literally the absolute perfect complement to your existing dividend yields. I'm going to pause right here for just a second. If you're finding this guide helpful, take a second to like this explainer, share it with fellow investors, and subscribe to Fox of Wall Street. Hitting that subscribe button ensures you never miss out on our latest investing and options strategy guides. Okay, let's move on and see how this builds into our risk profile. On the left, we see the absolute beauty of the strategy, generating immediate recurring cash flow. But on the right, we face reality, capping your upside gains. If this stock suddenly skyrockets on unexpected good news, your profits hit a brick wall at that strike price. You are intentionally trading away the rare home run for consistent, highly reliable base hits.
Section 4. Risks and downside exposure. What you need to watch out for.
Now, as a professional financial educator, it's critical we objectively discuss the specific risks, because no strategy is a magic bullet. Beyond just capping your upside stock gains, remember that your downside stock risk remains very significant. If the company's stock plummets to zero, your 100 shares still lose their value. The premium you collected only softens that blow by a very small margin. You also face early assignment risk. That means the buyer of your option can actually force you to sell your shares to them before the expiration date. This happens most often right around ex-dividend dates when buyers really want to capture that dividend. Because of this, the strategy does require active monitoring and occasionally making rolling decisions.
Comparing these two paths visually really puts it into perspective. The covered call gives you that steady income and it offsets minor drops. But look at the top. It's completely flattened out. Your upside is capped. Meanwhile, the traditional buy and hold strategy offers zero extra income generation on the side, but you retain pure unlimited upside if the stock goes to the moon. It is a fundamental exchange. You're trading potential growth for immediate capital.
Section 5. Best practices for investors. How to maximize success and manage your risk.
To truly optimize your returns, let's cover the essential best practices derived directly from our source material. First and foremost, you absolutely must choose fundamentally strong companies. Don't buy a terrible stock just because the options premiums look high. Second, avoid selling calls right before highly volatile earnings announcements unless that extreme volatility is an intentional part of your game plan. Third, target out-of-the-money strikes to give your stock some breathing room to grow. Make sure you are diversifying your positions. And lastly, always evaluate the annualized option yield. Don't just look at the flat cash amount. Calculate what that premium represents as a percentage return over a full year. That helps you understand its true value compared to other investments.
Our source also provides this vital market perspective on implied volatility. Higher implied volatility generally increases option premiums, sure, but it also reflects much greater price risk. So while elevated market uncertainty can offer juicy, higher premiums that look incredibly tempting to collect, just remember that this almost always signals a much bumpier ride for the underlying stock price. Risk and reward are always inextricably linked in the options market.
Section 6. Summary and next steps. Is this strategy actually right for you? Okay, let's summarize exactly who should be deploying this strategy. Here's your checklist. You need to start with 100 shares of a mature holding. You want to sell these calls in sideways or moderately bullish markets. You are the ideal candidate if you prioritize consistent cash flow over maximizing your upside. And crucially, you have to be entirely comfortable potentially selling your shares at your target strike price. If that happens, it means you made a profit, but you have to be completely willing to let those shares go.
So I'll leave you with this. Look at your own portfolio. Which of your long-term stocks are just sitting idle right now, waiting to be put to work? If you prioritize steady cash flow and want to optimize your long-term portfolio, the covered call is a remarkably powerful tool to understand. Thank you so much for watching this Fox of Wall Street guide. Be sure to subscribe for weekly U.S. stock market insights, option strategies, and investing education. We'll see you next time.